So, Rob, for most of the year, we saw this dominance of the big tech names, the Magnificent Seven, as they're typically referred to. What are your thoughts here as we sit in the middle of the year? Are we going to continue to see this trend, or do you think that we're going to see some broader-based market performance?
Yeah, I mean, the tech rally, I think, is really going to continue that story. It's a lot of earnings growth there. If you think about 2023, last year, the Magnificent Seven basically drove all the earnings growth. If we didn't have those 7 companies, we'd have negative 4% earnings last year. And a lot of this year, we're still expecting those companies to really drive earnings through the back half of this year. But the good news is, again, valuations can persist, especially when these companies are continuing to grow. And we talk about the AI revolution. A couple of these companies that are in the Magnificent Seven, you think about NVIDIA with their chips, Microsoft with ChatGPT and owning a lot of OpenAI. These companies are really driving all the capital expenditures that companies are spending money on. So those companies, and you think about second and third quarter growth, are going to drive a lot of the earnings. And then if you think about 2025, that's when you probably start to see some more broadening of the market, where companies that are spending all this money can start to improve their productivity, their margins, and they can really start to generate returns that kind of get closer to what some of these bigger companies are generating. So yeah, I think right now the Mag 7 is still going to continue the second half growth story, but I think when you start to look at next year, then we can start to see more of a broadening of the market, and some of those lower valued companies can start to maybe catch up.
And as I think about a lot of what's going on in the markets today, it just seems that there's a lot of risks that are looming out there, whether it's inflation, interest rates, the upcoming election, and a multitude of geopolitical risks. What are you all doing in terms of reallocation or repositioning portfolios, or even hedging strategies that you're putting in place to protect against these risks?
You know, as a fixed income analyst, it's exciting to finally be able to say fixed income can play the role of fixed income again in portfolios. If we think back to 2022, rates were really low. There wasn't much opportunity for yield or protection from fixed income. But with higher rates in fixed income now, duration is an extremely powerful tool advisors and clients can put back into their portfolios, that should rates fall in any type of risk-off market, or there's any concerns that take place, duration can really have an impact when rates fall and those prices rise. So from our seat, introducing duration to portfolios can be a very powerful diversifier to your equities. But in addition, within the fixed income side of the book, you can take a look at higher quality fixed income. High quality fixed income companies and borrowers tend to be more resilient to higher rates, or a lot of those risks we talk about in the economy. So moving up in quality across fixed income can also be a great way to manage the risk you see in the economy and in markets.